afternoon. Welcome to this event organized by IEG together with the Governance Global Practice. We're happy to have a number of colleagues from other institutions who are engaged in this area. So I'd like to welcome from USAID Anton. Anton, I'm sorry I don't have your full name. Let me get my notes, because otherwise it's not look good. Anyhow, we're happy to have all of you here. We, as I said, are happy to have Anton Kamenov from USAID, Agustina Schichman from IDB, Mario Mansour from the IMF, Blanca Moreno-Dodson from the Governance GP, and of course Jim Bromby, who is going to follow me with some introductory remarks. This event is organized around a report that IEG produced. It's called the learning type of report, where basically it's a synthesis of previous findings of project evaluations. It was led by Claude Leroy-Temez, who is going to make a summary of the main findings of the report after Jim kindly says a few words about how the World Bank is organizing itself to, in a way, up its game in this area, in this very important area. So the whole session is to take about an hour and a half, and we would like to spend most of the time having first discussions with the panelists that have kindly come to the bank today, and then we'll reserve the last half hours to have a conversation with you, and you'll be able to ask questions either personally or through your computers or mobiles, and so will people who are attending this online. So without further ado, let me pass it on to Jim. Thank you once again.
Thank you very much, Pablo, and good afternoon, everybody. It's a great pleasure to be here indeed. I'm the Director of the Public Sector and Institutions Group within the Governance Global Practice, and we're home to the Global Tax team. So we have a direct interest and, in fact, I suppose a stake. We all have a stake. We have, I guess, quite a defined stake in the nature of the report, and I think the discussions that are occurring here today. So I'd just like to say a couple of things really about, I guess, positioning the discussion here, and also outline just a few things about how we are already working to incorporate many of the findings, I think, and the insights from this learning review. That's not meant to preempt the open discussion about the implications, but it is, I guess, meant to at least give an indication of our own thinking and the manner in which we've tried to absorb and digest some of the lessons and insights here. First of all, we think that the review team led by Claude has done a truly outstanding job of capturing the main issues and the lessons, in fact, from the World Bank Group support to this area of work over the long period of time, over a decade, to 2015. So first of all, we really want to thank the IEG for investing the time and the effort, the intellectual curiosity and the endeavour to bring out the findings from this work. I think the IEG can be a great partner to what we're trying to do, and I think this is really an excellent example of that partnership working extremely well. I think that the report does cover the period of time where the bank's efforts in the area of domestic resource mobilisation or tax operations, where the efforts were very fragmented within the bank and between the bank and the IFC. We think quite a lot has changed since then. I think one of the really interesting things that the report does is that it really says that through a whole lot of micro decisions really taken in a quite uncoordinated way across many of our operations, we ended up developing a sort of an overall bank approach to this topic, which was perhaps not really in the interests of the bank or in the interests of development. So that might be a bit of a harsh summary, but in the interests of, I guess, the polemical discourse that we can have here today, I mean, maybe it's worth putting it out there. But we do think a lot has changed since then. So we think that the creation of the Global Tax Team has created a central focal point for the tax work in the bank and is acting as a single connector within the bank, but also to development partners and the international financial institutions. And so pleased to see our partners, the fund, represented here. I think a major effort of the Global Tax Team has been to organise the different business lines in tax policy, tax administration and international tax in a much more joined up manner so that they support directly the efforts of country teams, be they through country directors, country economists or governance folk in conducting dialogue and developing partnerships in the pursuit of development. So, for instance, in countries such as Pakistan and Vietnam, we've, I think, successfully supported and led a package of operational activities that address issues in domestic resource mobilisation comprehensively. And we've used a variety of instruments drawing from these different global practices to get to that point. I think in these cases, the synergies between the tax components of DPOs and investment projects are really reinforcing a productive and satisfactory outcome of that engagement. We're also, of course, with our partners at the fund, the OECD and the UN, developing additional tools for diagnosing and analysing. Of course, TDAT is a recent thing, which is the diagnostic assessment of tax administration, but the work we're doing very specifically with the fund on tax policy assessment frameworks is to improve both the nature of the work that we do, but also to get, in a sense, a better joined up approach across all the international organisations in terms of how they're dealing with countries on this important topic. And I think it's an important change because rather than, as this report sort of highlights, rather than relying on the IMF input, especially around tax policy for advice, it means that we can be much more mutually recognising the role that each of us plays and leveraging off that. In fact, as part of IDA 18, we've committed to conducting diagnostic exercises using the TPAF, or Tax Policy Assessment Frameworks, in 6 IDA countries until the year between now and 2020. We also, I think, rather than having to wait a decade to see whether or not the approaches that we're adopting now are good approaches, we've tried to enrich the nature of our country dialogue with a stronger monitoring and evaluation framework. This, of course, is also very consistent with the problem-driven, iterative, adaptive approach to designing public sector interventions of many sorts. But whilst much remains to be done, we have piloted this approach of intensive monitoring and evaluation in countries such as Afghanistan and Pakistan, where I think it's fair to say that the history has not been as necessarily as successful as we would like, and we think that more real-time monitoring and evaluation is likely to be very helpful going forward in creating faster feedback loops and getting that iterative adaptation that is necessary for successful interventions. I think it's very well accepted that improving tax systems is an absolutely fundamental key for financing development priorities, but it's also a fundamental key to the overarching aim of state building and developing citizen trust, for allowing the private sector to flourish, to support economic growth, and as well as to reinforce equity and fairness within and between countries. certainly a important and complex agenda, and an agenda which has changed quite markedly through time. So in that context, I'd like to say I think that we're trying to change to meet the challenges of that agenda as well, and I look forward to today's discussions. So thank you.
Thank you all for being here, and thank you, Pablo and Jim, for your introduction remarks. Today, I'm going to talk about the tax revenue mobilization, the lessons from the World Bank support to tax reforms. In the past, the World Bank has been successful in supporting tax administration reform, but less in tax policy, as Jim just mentioned it. And in addition, there has been some missed opportunities. And the review points to several ways to improve performance, and along the line, again, of what Jim just told us. But before getting to that, I would like to tell some words about what we have done. So why we're doing this? Because as we know, mobilizing domestic resources by reforming taxation is essential to finance development and compensate for declining development assistance. What we have been doing, we have been reviewing all the World Bank support over the last 10 years, both provided through development policy operations, but also technical assistance projects and IFC advisory services to business taxation. How? It's a systematic review of existing evaluation evidence, mostly implementation completion reports. And what are the findings? Some success was achieved in increasing revenue through tax administration reform. For example, in Guatemala, created a new tax administration after the conflict, and tax revenue increased from 8.8% of GDP to 9.8% in 2001, and 10.3% in 2006. In Mozambique, they were improving efficiency of the tax administration and then strengthening tax legislation, including the fiscal regime for mining and oil sectors. And in Paraguay, they improved the office capacity to audit large taxpayers. But in the area of tax policy, there was much less support provided and much less results. Sorry. Peru, for example, did not eliminate tax exemption as was planned under the operations. Jamaica made very limited progress in improving the uniformity of the tax code. And in the other finding is a number of missed opportunities, rarely addressed major structural weaknesses in tax systems, even in series of policy operations such as Colombia or Guatemala, Indonesia. In Colombia, tax evasion is estimated to 2 to 4% of GDP. And in Guatemala, the very recent systematic country diagnostic points to a very low domestic resource mobilization, with major deficiencies in tax administration, small tax base, and one of the lowest tax to GDP ratios in the world. There was also little analytical or diagnostic work to inform the design. And the hypothesis was mostly that the work was done by the IMF, especially when there was a parallel IMF program, and that was the case for over 70% of these operations we reviewed, and seldom observed synergies between development policy operations and technical assistance projects. Only it's observed in 3 countries, Guatemala, Sao Tome and Principe, and Pakistan. In Guatemala, the technical assistance project may have informed the follow-up subsequent policy operations. In Sao Tome and Principe, the potential synergies were not exploited because the overlap between the technical assistance program and the policy operation were only 1 year. And in Pakistan, both synergies were mooted by the lack of ownership of the government. So what lessons do we derive from this review and the existing evaluation evidence? And what matters going forward? Ensure and sustain government ownership, which is a real challenge. How do you do this? It depends on the country circumstances and on the capacity of the country to conduct reforms. And so there are several options depending on those circumstances. One way that can help is to assess systematically and thoroughly political situation and the government ownership. This is done in some recent operations which are still active and seems to be helping, like Pakistan Sindh project. Another way is to focus on measures that can be implemented at the under the control of the executive. And that was the case in Guatemala, for example, where they could not, the country was not ready for comprehensive tax reform. So the decision was made to focus on measures, on tax administration measures that could be controlled by the government. The second lesson is to sustain engagement to correct structural and systemic tax issues. As mentioned by Jim, we found a lot of fragmentation in the support, where ad hoc measures were implemented 1 year and the following year there was nothing specific on taxation, for example. So the way to address systematic issues is to sustain engagement. Better monitor and evaluate the impact of tax reforms. In a lot of cases, at least, in fact, in most of the cases, the main indicator used to assess the performance was the tax to GDP ratio, but you can't attribute tax reforms, results of to tax reforms with such an indicator. And there is a need to an evaluation at the very much more closer to the impact of the tax reform themselves. At the more strategic level, both at the country level and at the corporate level, we found that addressing other pervasive governance issues such as corruptions or weak judiciary system may help in the tax revenue mobilization too. For example, in Guatemala, in the customs, progress was undermined by the lack of measures against corruption. Better exploit synergies between policy operations and technical assistance, with policy operations taking the leadership on policy change and technical assistance building the capacity to implement those changes, but also technical assistance projects to help in the design of the policy change. So the point is about cultivating in-house the capacity to do diagnostic and advisory work, and we can see in more recent developments such as the Guatemala systematic country diagnostic that it's being done right now, but it was not the case over the last decade. And increase efficiency and equity beyond domestic resource mobilization. So to conclude, I would recap about the main message. The main message is progress was made in tax administration, very much less on equity and efficiency. And we hope that, that's not the right thing. With that, I'm leaving the floor to Pablo, who is going to run the panel, and I hope to have a lively discussion on the next hour.
Okay, well, thank you very much, Claude, for this very, very brief, concise presentation. Let me invite my colleagues in the panel, Agustina, Mario, Blanca, Shan, whom I may have not mentioned at the beginning, and I'm sorry. So, as I said, we'll be collecting comments and questions for the panelists as well as for Claude. So you can follow this event through Twitter, hashtag tax4dev, and you also have it in the screen. So let me just say that while Claude has made a very brief presentation with a few examples, let me say that she has reviewed over 100 projects. She looked at all the projects that had tax components during the period of about 10 years that was covered. There were about 200 projects. Out of those, about 100 had been closed and had been evaluated internally, self-evaluated by bank staff. And about 100 had also been, these evaluations had been validated by IEG. So the findings really reflect a very broad effort to cover all the portfolio on tax components. Those projects are in about 80% of the cases development policy operations. In terms of commitments, 95% are development policy operations. 2/3 of those DPOs have been led by colleagues from macro and fiscal management, and the rest is mostly by governance in addition to other sectors. So these findings really reflect a broad review of the bank's work in this area. Now we would like to hear from our panelists. Agustina Schichman, let me start with you. Agustina, you have been leading or co-leading with colleagues at the IDB a similar evaluation of the IDB's, let's say, track record of performance in this area. Could you share with us some of the findings and how they compare with the findings of this World Bank review?
Sure. Thanks, Pablo, for the question and for the opportunity to be here. As you mentioned, we are wrapping up an evaluation on IDB support to tax policy and administration between 2007 and 2016. So a very similar period that the one covered by Claude and her team. And to give you a bit of a background before jumping to our findings, countries in Latin America and the Caribbean carried out significant tax reforms in the 1990s, mostly to increase the tax revenue. Partly as a reform, as a result of this reform, and also because of the macro context, the region's tax to GDP increased from 14 to 18% in the 1990s and until the mid-2000s. Since then, reform efforts have been less frequent in the region, and now we see that there are large disparities between countries, right? On the one hand, we have cases like Paraguay and Guatemala that raise about 12 or 13% of their GDP in taxes, compared to countries like Argentina or Brazil that they raise twice that amount, right? So it's a very heterogeneous region. In this context, and now turning to our evaluation, the main objective of IDB's work on taxation during this period has been to help central governments and also subnational governments increase their tax revenue. And we think that this approach has been in general relevant because the IDB has tended to provide more support to the lower capacity countries, to countries that were very far away from reaching their potential. In tax policy in particular, the IDB's emphasis has tended to be to help countries broaden the tax bases, and usually on the personal income tax and the VAT. Whereas on revenue administration, it generally focused on non-compliance, and in particularly financing improvements in information technology for better audit capacity or for taxpayer services. And also it financed organizational reforms and training of staff. In general, what we found is that the type of support requested by countries has been very different comparing low and high technical capacity countries. In the more advanced ones, they generally turned to the IDB for very specific, like niche expertise, and also for the seal of approval. But it was in general in the more low capacity countries where the IDB had a more active role, more hands-on, what we call like hand-holding, right? Because they needed the IDB to be there for more day-to-day issues that were coming up. And something similar to what Claude was mentioning, maybe a drawback that we found in this type of countries, is that the IDB did not pay probably enough attention to governance issues, right? We also see that, let's say, the financial or political autonomy of tax collection agencies was sometimes overlooked. And for sure, this can have to do with both demand and supply issues. Now, in terms of the expected results of the IDB projects, we also find mixed results. And here we wanted to point out to 5 cross-cutting issues that we see. First, that tax policy reforms require tax administrations that are capable of enforcing the changes. So here what we see is that, again, usually when the IDB put in place a program taking into account both tax policy and revenue administration, results were more effective. Uruguay, for example, around 2007, requested IDB support to design a very comprehensive and a very ambitious tax reform that the bank supported with a policy-based loan. And in parallel, there was an investment loan helping revamp the tax agency. Second, coordination among multilaterals is very important to help build, and sometimes, certainly not enough, but try to secure consensus. Jamaica, for example, right? The most multilaterals have been there for many years trying to help the country move forward with some reforms, especially to try to reduce some of the distortions in the tax system. And certainly here we also see that there is space for further coordination and synergies. Third, as we all know, tax reforms are very time sensitive, and they certainly require lots of committed counterparts and country ownership, to navigate the political economy. For instance, in cases like Honduras, what we saw is that it was precisely the lack of government ownership, or sometimes the opposition of the private sector, like in Guatemala, that led to policy reversals and sometimes to the deterioration of the collection agencies. Fourth, another of our cross-cutting findings, and again, similar to what Claude was mentioning, that long-term sustained engagement, it's fundamental in these cases. It's not just a matter of being there during the project. No, even once in this case, the IDB projects were finished, it was very important to remain there, to keep giving advice, ad hoc advice to the countries. Which I'm not saying that always happened, right? We are saying things that we noticed that were important to try to get more results. And finally, that these tax policy and revenue administration reforms are not necessary, are not sufficient, sorry. What we are saying is that, as Claude found out, that there are other institutions and checks and balances that need to be in place. And probably there's where our institutions also have a role to play, right, beyond taxation.
Thank you so much, Agustina. It's very interesting to see this great parallel in the findings. So let me pass now to Anton. Anton, USAID is involved in this area in many countries, and I think you have some interesting findings from your experience in that area. Can you share with us a little bit what USAID has learned through the work in tax?
Sure, and thank you for giving me this opportunity to get as close as to a rock star as I'll ever be. Instead I chose to work in taxation. Yes, so the first and I think most important thing to say is that our experience confirms the lessons of the report. We've been the US government has been providing technical assistance in tax policy administration for decades, since long before I was born. And yes, we find that obtaining government commitment, understanding the local and institutional context, long-term sustained technical assistance, especially in tax administrations, is very important. Those things have remained constant for us. Now, a few things have changed. One is the importance that the international community gives to this type of technical assistance. And we heard it in the introduction from Jim. He said it's important and a complex agenda. Domestic resource mobilization is now part of the Sustainable Development Goals. The Addis Tax Initiative was started in 2015. USAID was a founding member. And we now use this interest by the international commitment to encourage governments, to encourage them to participate in the Addis Tax Initiative, to encourage them to undertake the Tadat. This is one form, one way in which we try to build government commitment. Now, a couple of interesting things I also would like to highlight is, yes, we understand that, as the report notes, it is hard to obtain long-term government commitment to do the right thing in taxes. We can do it so in the short run, but governments change, the context changes. And one thing we have learned recently is that, well, I think we've known for a long time, but only recently we're putting a huge emphasis on it. This is that one way to obtain long-term government commitment is not to us, but to its citizens. So nowadays you will see a lot of our projects are implementing components that are focused on public-private dialogue. And we do so in many ways, from the simplest things such as ensuring that the government provides the right information to citizens, to building the capacity of civil society organizations to be able to analyze tax policy or work with the tax administration on compliance costs, to actually formalizing public-private dialogue forums. And the other thing I would like to highlight is monitoring evaluation. A lot of the things that the report says about monitoring evaluations are correct. We, and I actually, as everybody else has already noted, not to sound like a broken record, but we now are looking differently at monitoring evaluation in the sense that, first, revenue is not the only piece to working in taxes. The cost to the taxpayer is another. We could easily improve the business environment without actually raising revenue, or without impacting revenue, I should say. And third, the cost to the government. We don't pay attention to that as often, but how the government does business is also equally important. And another thing about monitoring evaluation is, as Claude mentioned, it is hard to attribute our changes in these broad categories such as revenue raised or cost of compliance decrease to our projects, which may be narrow or which may touch only one of very many broad areas. And so we're nowadays looking into, well, what do the lower level indicators mean? How many people file electronically? What is, how many people spend days in the tax office doing this, that, and the other? How do those indicators relate to the higher level indicators that we're trying to accomplish? These are the sort of new ways we're trying to address the same old challenges, on top of the constant things that were already noted and mentioned that have been going on for a while.
Thank you very much, Anton. As I said, I think this focus on public-private dialogue, on building domestic pressure of civil society for improving revenue mobilization is something quite intriguing. And I'm not sure we've seen a lot of that or any of that at the bank. Mario, you've personally been engaged in over 30 countries providing advice on tax policy and tax administration, and the fund is involved in this area worldwide. People say that at some point in the 1990s, there was a division of labor between the bank and the fund, and the bank sort of focused on the expenditure side. The fund remained fully engaged on the revenue side. So can you tell us a little bit what the fund experience has been in terms of the challenges and ways to address them in terms of promoting improved revenue mobilization.
Well, first, thank you for the invitation, being here. It's always a pleasure to cross the street, and which I don't do as often as I should. And let me step back perhaps a little bit and give you a bit of my view when I joined the fund about 12 years ago on how I saw the IMF work and the World Bank work as a tax economist back in Canada. So the one thing really that working with other banks colleagues that struck me in the bank's model back then, which I think what you're trying to address now, or have addressed to some extent by changes to the organization, is that you saw a bit of a fragmented approach to advice in the tax area, whether it was administration, very little policy, I think, as most have mentioned. But you also saw a bit of jumping stages. So the approach to advice was, to some extent, driven by some unknown factors rather than what is the process to take a country from point A to point B, even if the distance between these 2 points is very short. And I'm not saying that the fund didn't suffer from some of this. It did. But given the way the fund is organized, it showed less to the newcomer than with the World Bank. And obviously, I think the relationship, to some extent, working on common projects was more difficult than it is now, for example, in the context of some issues that we're working on together. At the fund, over the past 10, 15 years, what we had to manage is essentially going from an operation that gives about 30 to 40 missions a year to now over 150 activities a year and over 120 countries. In the policy, we do about 60 countries a year, 100 activities, and in the admin area, about 150, plus the regional technical assistance centers. So it's a huge operation, probably the single biggest in-house operation. I think two things to take from the fund, and again, looking at it both as a beginner, beginning my career at the fund, and even more now, looking at the past 10 years, I think what we do well is, and where the bank probably could think about, and is actually doing some of this, is one, the capacity is mostly in-house. You're controlling the quality, the timing, and what you deliver to what country, whether as part of an IMF program or whether as part of regular demand-driven TA. All our TA is, in principle, demand-driven. In some cases, support is given to programs, but even in the program context, the country has to show that it wants actually specific advice on taxation. The other thing that I think the fund exploits very well is the interaction between lessons learned, or what we call analytical work, that's another way of putting it, and technical assistance. We always draw on problems in the field to feed the analytical agenda, either to the board or as a standalone projects, working papers, how-to notes, etc. And the third component, which is now one with the World Bank, which we've been doing a lot more of recently, is cooperation with others, international organizations, bilateral donors. For example, a significant portion of our work in natural resource taxation, it's roughly about 1/3 of our work now. It's huge in terms of resources. The idea started at the IMF, but resources for this work were not present. And collaboration with others allowed us to build not only the expertise for this, but also make it available to countries around the world. So these are some of the things that I think, some of them are already actually in the evaluation and were touched upon during the presentations.
Thank you very much, Mario. Maybe perhaps a quick word on how do you see the evolution of the bank work in this area while you've been at the IMF. Collaboration has been increasing lately. but any experiences from previous years where perhaps this was less organized?
I think collaboration with others is, I'm not sure that this is something we can do without, even if we wanted to. The world is so interconnected. International organizations are so important to the world now that collaboration is inevitable. One has to choose how, when, and where, which is really what we try to do now. I think the World Bank has advantages that an organization like the IMF doesn't have, or the OECD, which is the presence. The presence in countries is amazing. I mean, I've been to countries where bank offices are essentially the size of my department, the Fiscal Affairs Department. So that gives you a huge advantage to organize certain aspects of technical assistance in the context of the reorganization of the IMF, of the World Bank with the global practice. The second is, I think, we have to learn, and we can learn from history and the strength that the business lines that we bring with us from history. The bank did a lot of work in the area, for example, of business environment, essentially corporate taxation, small business regimes. Now this work has been integrated in the global practice. It can be exploited a lot better because you're looking at things from a global perspective rather than individually, what the corporate tax rate should be, independently of the rest of the tax system. Combining this overall perspective gives you, I think, a better position to exploit what you have been doing for a long time. The other thing that, and maybe indirectly related to this is, going forward, I think all international organizations has to keep things in perspective. Over the past 20 years, low-income countries increased their tax ratio by about 5% of GDP, which is huge. That's about 50% of what they had. Now, the Sustainable Development Goals is asking them to go to 20% of GDP in the next 12 years or so. And I think international institutions has to remain a little bit realistic about the potential for growth in some countries. Not all countries did as well. Some countries actually regressed, and some countries are just stagnant. So there's obviously a lot of work to do in these countries. But from a global perspective, I think we have to go about the policy and the administration work with the idea that this in itself is important to improve tax systems, even if you're not raising revenues. It is important to improve the image of a tax administration and the integrity of the institution and how people perceive it, even if you're not going to raise more revenues. It's not all about revenue. So unless we recognize this and we include this in our projects for countries, I think we're going to be disappointed 10 years from now. And that goes back to one of the comments that was made, I think, about the tax ratio as the sole objective of judging success, which, if you work in my area, I'd say this is completely insane.
Thank you very much, Mario. So the idea that you will get significant policy reforms in tax systems on a continuous basis is probably a myth. And that doesn't mean that you're not achieving progress if you're not raising that outcome indicator. The challenge, perhaps, as the review shows, is that oftentimes nothing else is monitored, right? And even when that's the only indicator that is monitored, when you get achievements, it's difficult to attribute to the factors external to the support of the bank and the fund and others. So let me go to our colleagues who have kindly come from MFM and from governance to tell us about the work that the World Bank is currently doing. So let me start with Shan. You're based in the MFM GP. Can you tell us a little bit about how the bank is now engaging on tax policy reforms in addressing the issues that have been highlighted by Claude's review?
Thank you very much, and I'd like to also congratulate Claude's team for coming out with this report, because a lot of conclusions that they've come out with are spot on. And Fortunately, we have been already working on fixing those even before the report was finalized. So I'm happy to see that we are all in the same, moving in the same direction. I think one thing that has been very clear, both from the report and from our work in the past few years, is that tax administration and tax policy cannot be done separately right from the beginning. And so this ad hoc approach of what the government is asking is somewhat risky unless you really look at these two aspects together from the very beginning. The advantage of the report that we have just found is it has actually presented data to also show that over the last decade, what has been important is that political economy dimensions and the continued engagement are two aspects that really are very critical. Again, this requires organization within the people who are delivering the advice to governments. In the bank, since the formation of the global practices, the risks have always been there of fragmentation, and that's why the creation of the global tax team has been very good, to the extent that right from the very beginning, the policy and the administration aspects are on the radar screen. Let me give you two specific examples. Right after the July 2015 UN meetings, we decided to put together a multi-GP coordination team with the IMF that we now meet. Initially it was weekly, now bi-weekly, to actually coordinate the development of diagnostics and also, to some extent, our global activities. Looking at the global activities, we have now started having side events during the annual and spring meetings on a very regular basis jointly with the IMF on issues of tax. It doesn't have to be all issues, but what is the issue of focus that we'd like to emphasize? So I think we are trying to organize ourselves to not lose sight of the fact that these two aspects of taxation have to be done from the very beginning, both on a country level as well as the global level. One more point I wanted to highlight on was this issue of the indicators that you talked about. And here, I think it's important to look at the sectoral depth that is needed in the context of tax reforms, especially in tax policy, because what happens is it does have impact on both efficiency and equity aspects in sectors as well as in the economy. This has to be brought in also, as your report correctly said, right from the very beginning in trying to look at these dimensions. And the advantage that the bank has now, especially with our twin goals, that not only are we looking at poverty impacts, but also the impact on the bottom 40%, which is the middle class and jobs and things of that sort, which causes a very different dynamic to include business environment, issues related to the mining sector. And this is where the global practices have very good technical expertise. And therefore, our macroeconomists in the context of DPOs have played that integrative role of bringing in this deep sectoral knowledge colleagues together to discuss the tax policy and administration aspects from the very beginning. And I think this is something that will add significantly to looking at both the political economy dimensions, and our country economists, in fact, the thing about them is after a couple of years, they actually know more about the country than a lot of people in the country, because they really on the economic side and the fiscal side. So I think it is very important to have that positioning on the ground and take advantage of it, and then use our big offices, which have sectoral colleagues who really know about the sectors, to then look at the efficiency and equity dimensions in the sector that some overall tax policy may have, and maybe making it inefficient and so on. So we need, I think it's very important. So I see all these movements in the right direction. Thanks.
Well, thank you very much, Shana. I guess your last point about the World Bank bringing to the table this deep sector knowledge on the impact of the tax system and on the business environment is something that is consistent with what Mario had mentioned as being one of the areas where there's complementarity. So, Blanca, you are, the the global tax team is hosted in the governance GP, and you're part of that team, and you're working on developing this tool, this tax policy assessment tool that Jim mentioned. Can you tell us a little bit about these and other tools that the bank has been working with partners on developing, and what the challenges have been as you work on those new tools?
Thank you, Pablo and Claude, for inviting me to participate in this panel. Before I answer the question, perhaps I want to give a bit of the background of how we operate, and again thank Claude, congratulate her for how timely this review was, because not only it covers the portfolio up to 2015 when the Addis Tax Initiative was launched, and pretty much the global landscape in which the DRM agenda operates changed for all of us, but also because the signals that the report gives to all of us working on taxes are extremely relevant. So in 2015, what happened is that for the first time, the DRM agenda was recognized at the center of the Finance for Development agenda. Domestic resource mobilization is not only needed because external aid is coming down, and because after the global crisis, a lot of countries recognize that they need to have additional efforts to mobilize their own resources, but also because tax reforms are linked to many other aspects of the sustainable development goals. You cannot look at one of those goals without looking at taxes. You look at climate change, you have to talk about carbon taxes. You look at health, you need to talk about tobacco taxes. So taxes are not just in one of the goals, but they are all over the agenda. And I think that has changed the way we all of us operate. Basically, the message for us was that we need to work together and explore further the synergies that we have across the institutions. So right after July 2015, the bank and the IMF, and now I come to the question about the framework for collaboration, announced that we would design together a tax policy diagnosis framework. And a few months after, the platform for tax collaboration between the fund, the bank, the UN, and the OECD was created. Those two were really game changers. I think for the first time, the bank and the fund decided to create a guiding framework as opposed to working in a coordinated way, but without a systematic way to do so. And what we're trying to do is to precisely design diagnostic framework that would help our staff in both the bank and the IMF to look at a tax system in a comprehensive way along the different dimensions of performance, domestic resource mobilization, equity, efficiency, and administrative feasibility. That necessarily means that we have to go tax by tax, and that's exactly what we're doing. The other novelty of this framework is that it will be web-based. That means that anybody who is working in a tax reform in any country will be able to access it. And it will have all the resources, meaning references, country examples, and that you will need to do that analysis. For example, now we have a client that says we want to look at the VAT and the VAT only. But you cannot do that without looking at the rest of the tax system. So with this guiding framework, you will be looking specifically at the VAT according to all these dimensions of DRM, efficiency, and equity, but also you would be doing a broader analysis of the tax system so that the VAT reform fits in the context of that tax system. And that will nicely complement the TADAT that had been previously developed to guide the reform in the tax administration. I think it will make reforms easier because the IMF and the bank, even though we will continue having different operations because we have our DPLs, they have their TA, but we will be using a common guiding framework, and I think that's the main difference with the way we operated in the past. And if you allow me, maybe I can add a few things about the way the global tax team works, not only in cooperation with the fund and the other tax partners, but also within the bank. I think because of the multidimensional nature of taxation that I mentioned at the beginning, the bank is in a very special place because we have our health experts, we have our telecommunications experts, we have our energy, environment, climate change experts, and we can bring that, the health experts, we can bring that sectoral knowledge to the tax agenda that's very much needed and that can complement what our colleagues so nicely do in the area of tax policy design. So maybe I'll stop here and then take other questions.
Well, Thank you very much to all the colleagues in the panel. We will now open for questions from the audience. We already have some questions from the web. So let me ask if there's any additional questions here from the audience. Otherwise, we will go to the questions that come from the web. Sir, you can come to the mic, please.
The only person in this place who is going to question this increase for sustainable development or whatever, the tax increases. And that's because of my private sector, background. I actually worked in the team, so bear with me in that sense. Look, Norway has 40% tax, by GDP, but they have also got Norwegian system of using the money, and so nobody is talking about what's going to happen with the money. So all this coordination, etc., is basically focuses totally on intake, and there is no, dialogue about what benefit are we going to get as a private sector person, so if you increase Uganda's number from 10% to 25%, who is getting that benefit? And I want you to address both from the World Bank side as well as the IMF side. I understand you've got a good system of having all the data, etc. Nobody can get out of the net, but you've got to understand. Otherwise, you will have fantastic opposition to these kind of increases.
Thank you for that comment. Let me go to some of the questions that we got through the web. Let me make the first question to Mario, our colleague from the IMF. There's somebody in the web that has asked us to describe the extent to which systemic reform focuses on electronic filing systems. So, in other words, what is the role of electronic filing systems in the overall efforts to improve tax administration?
Well, I would say quite important in developing countries, but there are big differences with, let's say, an economy like an OECD economy. The first thing that one has to keep in mind is that in a developing country, often individuals, most individuals, maybe 90% of a country's individuals, do not file or do not by law have to file. And the reason is simple, is because these individuals either have very low income or their main income is wage, so it's withheld at the employer's level and the tax administration discharge them of any additional obligations. This is not the system everywhere around the world, but capacities of tax administrations in developing countries makes it that it's often de facto the case. So electronic filing mainly is geared towards companies. Companies act as collection points for the corporate tax, for VAT, and for the wage tax on individuals. And in a lot of developing countries, actually, this system is being introduced. E-filing is being introduced. It's recent. It doesn't date, I mean, it's recent even in OECD countries, right? The internet is what, barely 20 years old. So, so by recent, I mean, within the past decade or so. Digitalization has the potential to actually improve quite significantly, not only administration, but the design of tax systems. So we worry about how to get information, for example, about individuals who earn revenue other than wage. Let's say business income. You have a business and you owe taxes on your business income. So technology can play a very, very important role in not only informationally speaking, by gathering the information from third parties, but also by reducing the cost of compliance.
Very good. We have a number of questions on the links between the agenda of domestic revenue mobilization and the twin goals. So, for example, can shared prosperity and poverty be achieved without achieving these domestic resource mobilization goals? Is improved domestic resource mobilization critical for achieving the bank's twin goals? Let me see if perhaps Blanca or Shan, since this is a World Bank focused question, can say something about it.
I'll be brave enough to start. Well, I think this links very nicely with the question that was asked about what is the private sector going to get out of this. And I think we have to make a difference between mobilizing revenues and increasing taxes. The two are not the same. In fact, you can mobilize revenues by simplifying the tax system. That doesn't mean an increase in the tax pressure or the tax rate. You can also improve the tax administration without changing the policies, which means that you are going to eliminate avoidance and evasion, and that builds credibility in the system, and that's very good for the private sector, as you know. And I think the equity dimension of the DRM agenda for me is the most important because, as you know, a lot of economists like Piketty point out that inequality has increased in many countries because the tax system has not done the job of distribution. And I don't mean redistribution, I mean distribution. Many tax systems are really biased against labor and they aren't taxing enough capital. So all those trade-offs need to be addressed in the DRM agenda. It's not about raising tax rates, it's about raising revenues. The other point is that to raise revenues, sometimes it's not a matter of just changing policy or administration. It's a matter of removing the structural weaknesses that are behind. For example, a country that relies heavily on agriculture is hardly going to make improvements over time unless the economy is more diversified. A country that has very high levels of corruption, the institutional performance is very low. It doesn't matter what kind of tax policy you put in place, you will not see results. So I think the DRM agenda is not only about policy and administration, it's also about removing all those weaknesses, and that's actually very good for both the private sector and for the levels of equity in the country.
Thank you, Blanca. But what would you say to people who say that most of the redistribution that takes place through fiscal policy occurs on the expenditure side? Maybe Shan can comment on that.
I was exactly going to come to that aspect of it. I think in the public expenditure reviews that we've been doing recently in the last 5-8 years, as the IEG report has also emphasized, if we need to look at it in a more holistic way, it should, for DRM, domestic resource mobilization, it is not only about taxes, it's also non-tax revenues. In addition to that, when you change tax policy, it causes trade-offs between who is going to benefit and who's not. And that comes to your question about, is the taxpayer seeing any gains from paying these taxes? So we have started using things like the World Development Report that talked about behaviorally informed tax policy. And we did some work in Guatemala on that by basically improving tax compliance, just the way taxes are collected. And in public expenditure reviews, in the macro chapter, to look at the revenue side a little more in detail than just the expenditure side. And then to basically say that, well, if you change a tax policy, this is going to be the impact on equity and the labor deciles who are going to be affected by it, vis-a-vis expenditures through transfer payments. And then even in the poverty analysis now, it's not only about looking at Gini coefficients, but we now look at things like the Kakwani index and other things that looks at the net effect of tax as well as transfers going by decile to see the net impact on the income of those households, and then say whether a tax policy is having an impact on the poor or not. So even the techniques for how we evaluate these things have changed recently, and we have now started adopting those in our work. And we do, in fact, the Poverty GP has excellent experts in that, looking at the impact on the poor and the different deciles. And that's how we're changing it, to incorporate this together now, expenditure and revenue.
Well, that's all very, very promising. The review that Claude did basically found very, very little reference to analytical work on these issues as you know, underpinnings for the operations. In some cases, there were references to IMF work. It's good to know that now the bank is moving ahead with increased emphasis on this. Let me ask Agustina a difficult question that came to us, so maybe you can help us. Basically, there are a couple of people who wonder if this is so important for all the international financial institutions. Has the World Bank or other IFIs considered being stronger in terms of conditioning World Bank or Inter-American Development Bank support on serious efforts on domestic resource mobilization? By the way, DRM is also the acronym for disaster risk management. What do you think about that? I think we have some views based on Claude's work, but would it work to be stronger and impose, rigid conditionality for support to countries?
Sure. Well, yeah, I think that's a tough one. But so for what we saw, actually, at least in Latin America and the Caribbean, but I'm sure that this is probably the same in other countries, it's very hard to impose conditionalities. I mean, countries, they, most of them want to be the ones that are taking the decisions. Many countries have very high technical capacity in their own countries as well. And it's very hard to go there and say, you know what, you need to do this, Y and Z to get to a certain point. We can maybe try to work with them, right, reach certain ideas together, but imposing conditions, I think that at least for the experience at the IDB has generally not worked. That does not mean that in our policy-based loans, we do have conditionalities, but to the extent possible, they are negotiated with the stakeholders, right? So there's a commitment from the country that they also want to reach to that point, and we should be there to try to help them to reach where they want to be. But imposing without taking into account what the countries want, it hasn't shown to be effective to get reforms.
Thank you very much, Agustina. I would say that is also the conclusion from the review of the World Bank support. Basically, what we see is a lot of backtracking. We see some operations during crisis where government has agreed to do things that later on have proved to be politically unrealistic. So it's really about moving in this direction when there is ownership, and it's about using analytical work and dialogue to build that ownership. But pushing for reforms when that ownership is not there has indeed been a big challenge. So related to that, there is a question that basically suggests an important role for the emerging middle class in many developing countries for being a domestic force. So Anton, I'm looking at you because USAID has now introduced these public-private dialogue components in basically all the operations in this area. What has been your experience in terms of an increasing role of the middle class in pushing for better governance in general, and in a way conditioning their participation in raising revenues to improve services? Any views on that?
I love this question that came out from here, which is what do we get for money? Because interestingly enough, in every single country that I have been, this question pops up. And it basically means that the most basic question about taxes is not about taxes at all. It's about services. And so services, public financial management, domestic resource mobilization kind of have to go hand in hand. Now, we, on the middle class, there's two aspects to it. Now, we try not to play in the realm of can we use the tax system to encourage the development of a middle class. On the other side, can we use the middle class to encourage the improvement in a tax system? Yes, that's a very possible scenario. I want to give you an example of because I can see other questions popping up that are related of how this could possibly work. And the example is an interesting project. It just ended in December. It was Armenia. Why is it interesting? Because it was one of the places where the World Bank actually was providing a serious amount of funding for an IT system. We were collaborating at the same time to help the government with the procurement of the IT system. Now, what happened in Armenia is that it was the one place where I saw the government formalizing a public-private dialogue by the Minister of Finance issuing a decree that says, you, Ministry of Finance, specifically this and that group, have to meet with the private sector on a regular basis, potentially monthly, to discuss topics of tax policy. And the questions that come out of these topics have to be answered by the government. And obviously private sector, businesses, civil society organizations, as well as taxpayer focus groups, which is where the middle class comes to play, could actually have a frequent and a loud voice in the design of tax policy, as well in the design of tax administration processes and systems, etc. And it has worked really well. The government doesn't have to necessarily reform based on every single question that is asked, but does have to provide an answer, and does have to move in certain cases. We try to separate the issue of taxation and spending, and I realize that this question will keep coming up. Well, what do I get for the money I put in? And even if we don't increase the tax rate, more money for government means less money for the public, one way or another. It is very dangerous in tax policy to go down this road. I think Mario was the first one when we had a conversation a couple of weeks ago about it that said, yes, you know, those two things have to be linked, but you have to do it in a careful way, because it is very easy to erode tax policy by starting to think about all the potential ways in which you can use tax policy to influence other pieces of the economy. I don't know if that answers the question.
Yeah, I think that it provides some useful insights. So careful with earmarking was the last message, something that Mario has emphasized. Let me go back to Mario for another difficult question. This is the link between tax policy and natural resource management. So the questions are, any tax revenue to de-incentivize overexploitation of natural resources and promote conservations. And there were a couple of other questions linking how is the environmental sustainability agenda taking into account when designing programs to support tax policy and administration?
I wish my colleague Thomas was still here. He could give a better perspective on this. But my first reaction is to this question is that the tax itself, by its existing, is a disincentive to exploit. So it's good that we have taxes on natural resources. It's not good that in many countries they are low. Why? Because natural resources gives you something that we call in economics economic rent. Basically, it's a super profit. It's a profit that the company doesn't expect when it invests. So companies, when they invest, expect a return on capital given a risk profile of the investment. Anything you get above this is actually cost you nothing. It's just, so for example, commodity prices go up, etc., things like that. Countries don't do enough of this. And actually, a lot of our work over the past 10 years in countries with natural resources was to show them what the pattern of revenues for the government could be relative to what they're doing now. So in essence, showing them what is the price of inaction. If you, instead of telling them do something, that it's good to do this, sometimes it's better actually to do the opposite thing, is to show them analytically what happens if you don't take this action. Essentially the consequences of inaction, which in the natural resource area in terms of revenues could mean essentially missed opportunities for countries to change its development forever. Because natural resources are non-renewable, right? If you miss the revenues today, they're gone. You cannot recuperate them tomorrow. The company is not there to be taxed tomorrow. It's there only today to pull the resources from the ground. The issue of sustainability, if what it's meant by is the environmental implications, well, as you know, and the bank does a lot of work on this, the exploitation of natural resources always come with something that we call, I mean, in plain English, cleaning up the site, paying for the environmental damage, whether it comes from transporting the mineral or the oil or pollution or whatever. My own view on this is that developing countries don't do enough of this. The regulations for actually, let's say, clean exploitation of natural resources often are good on paper, but not really enforced. So there's a scope for doing a lot more, for the World Bank to do a lot more work in this area. And let's not also forget that in these countries, natural resources, and by these countries, I mean in the developing world, natural resources are almost always exported. So a tax on this is actually good because it's a tax on consumers in other countries. And there is no better tax than taxing consumers of a country that is not yours. That's the best tax you could have. It has no distortions on your own population. And so we need to keep this also in mind when we design regimes for natural resource activities.
Thank you very much, Mario. Very interesting points. Let's open it again to the audience here.
I have a question to Mario on this.
We had somebody who had raised their hand before.
Just on this point.
Okay, very quick one, Surajit.
You know, I mean, you talk about exporting as if there is no competition, okay? So I'm taxing, say, Saudi Arabia's oil, and in the meantime, Iran grabs the market share. So what good have you done? So you have to be careful when you think about, you know, taxing and about, you know, putting this. Maybe the oil price will never rise again to the higher level. So I don't get it, you know, like your one country model and exportation.
Thank you. Thank you. Do you want to react quickly?
Yeah, quickly. The standard tax competition model in the natural resource sector doesn't hold. Actually, we've done work recently with colleagues at the fund in a book on international tax issues and natural resources. We've done work that showed actually that tax competition in this sector have been upward, meaning that countries have been competing to raise their taxes on natural resources higher rather than lower. And I mean, I don't want to go into the details, we can explain why, but essentially this tax competition model applies if you have no rent, if you have no super profits. If you have super profits, in theory, not in practice, and again, without going into details, in theory, you can tax at 100%. And one simple example, as you mentioned, Saudi Arabia taxes at 100%. Why? Because it owns the company that exploits its natural resources. It's a single company. Everything that this company does goes to the treasury. So in a sense, it's equivalent to 100% tax rate. There is no competition in the country.
Thanks, Mario. We have somebody at the mic, and Marco, you might want to go to the mic as well.
Okay, thank you. Hi. Congratulations to Claude and also to Agostina and all of your colleagues for these reports. I haven't seen the IDB report yet, but I look forward to looking at it. So I want to come back to something that was discussed just a bit earlier about the objective being to raise revenue and how to use that revenue, right? It gets to like the spending side of addressing equity concerns. But I want to come back to sort of a point that Mario made about maybe the goal, it's just important to address and reform tax systems, not with the overall objective just to raise tax revenue, because you can have impact from the system design itself. So given that the bank, the fund, and USAID are here, I have to ask a question about the Honest Tax Initiative, which has a conference in Berlin next week. And that is, does this concern about equity, how does that inform sort of the commitments that institutions and donors are making through that initiative? Because the overall commitment is to double technical cooperation, not double revenue. So how do you see these equity concerns fitting into sort of the types of assistance, whether it's technical assistance, whether it's policy advice, coming from the institutions and donors to address that? Thank you.
Let's take the final questions before we go back to the panel and close. Marco.
Okay, mine's a half question, half comment. And it's related to basically going into ADIS, financing for development, where we, the World Bank, then positioned ourselves as this mobilizer. So we're not anymore a lender, we are this mobilizer of resources. We can use our lending, our technical assistance, and our convening power to actually crowd in, leverage other resources. And the whole premise of this is like we need all resources available, which are international, domestic, private, and international. And ever since we set this ball in motion with the billions to trillion and then with the forward look, and now it ended up with this cascade, this so-called cascade approach. And I think the last year and a half too, the whole focus has been on private sector. And me as one of the co-authors of the Billions to Trillion, and we actually started with the second chapter after the introduction was domestic resource mobilization. And I always kind of felt that it sort of got lost in translation, the whole mobilization discussion, with DRM being left out of this whole cascade, and Jim came at the last annual meetings and the spring meetings going out. It's about private sector, how do you mobilize the private sector, and let's look at the cascades. But if you then break down the cascade, which is private, public-private, and then public. And so my question and half comment is, how do you fit in everything that we've been discussing into the cascade approach, and when we go then into a country or even at single project level, because everybody's now talking about the cascade and you first start at the private. And I'm thinking, no, in many countries, you actually got to start first at the public, and then you bring it up from there, and then maybe it could be public-private, and maybe just potentially it could be private. But I always see this discussion starting from the private and then going down. So I'm just thinking this is, again, within the FFD agenda, this is a wonderful opportunity to bring in all our DRM resources within the cascade and within the FFD agenda. Thanks.
Thank you, Marco. So we have two questions to end this very interesting discussion, and I'm going to ask any panelist who want to say anything about it. The first one is, how does equity concerns fit into basically the commitments that started in Addis? And the second one is, how the link between the approach that the World Bank has been promoting of focusing on bringing the private sector to finance development with the chapter 2 in your document that was about raising domestic resource mobilization. One could think that there are trade-offs between them or not. So any thoughts? Anton, you want to take a first shot?
Yeah, so first, just to clear up on the commitments of the Addis Tax Initiative, there were 3. The donors committed that they were collectively double support. Countries themselves, developing countries, committed that they will substantially increase resources mobilized. And there was a third commitment, which was basically to synchronize, which is, I believe it's still to be fleshed out. But let me give you our perspective on why we think raising revenue became an important piece. One thing we saw when we were examining our past projects and just what did we do in the past, we noticed that development assistance in general is plateauing, if not decreasing. It's hard to come by. We need money to finance priority sectors. For us, those priority sectors could be health, education, agriculture, etc. In those sectors, given the development assistance is going down, we have a choice. We either raise domestic revenue or we convene the private sector. The private sector inflows into countries have increased, but we don't believe that, you know, these inflows and domestic private sector is actually going to these priority sectors. We believe that if we are to be putting money in health and education and agriculture, the primary source for these funds will be domestic revenue. Now, this is why we have to raise domestic revenue. It wasn't just raising revenue for the sake of revenue. And this is, in fact, how we see revenue playing an important part in this issue of equality. Now, we are talking about, well, I'm going to skip the technical part of equality in taxation, but we see raising domestic revenues as basically an effective form of development assistance. You know, we could be going in and spending money directly into health, or we could be helping the government raise money, which chances are will produce larger amounts. And, you know, the whole idea that a rising tide lifts all boats. You know, it is likely that if the government can raise more money, they will spend on many priority sectors that we can see. You know, we looked at our past success stories, and we have not always been good at measuring our past successes, but in some of our stories, we're talking about $1 invested in technical assistance for tax policy and tax administration, and a $20 coming back, which the government could potentially be spending into health and education. And we see that as a very effective way of doing business. And so for us, we actually just started a domestic resource mobilization pilot program. And in this pilot program, we're encouraging USAID missions up to a limit to take a small amount of money which would have otherwise been mandated for spending in health and education, and transfer that money into assistance for raising domestic revenue, for the sake of hoping that this raised domestic revenue will actually go into the sectors that we care about.
Thank you, Anton. We're running out of time. Any thoughts, Shan?
Thank you. On the second question, excellent question. I think there is a very clear, at least the way I see it from macro fiscal, there's a very clear link between the cascade and the approach that we are trying to do here in terms of raising revenues. One of the things related to the cascade is, as you said, the role of the private sector. For the role of the private sector to be there and be interested in a country, there's another word that we have been using from our side of the street is, or the building, is de-risking of countries. In order to de-risk the countries, you need to ensure that the private sector that is entering into public-private partnership contracts in infrastructure sees the fiscal sustainability of the country that is handing out these contingent liabilities in terms of guarantees or PPP agreements in energy and infrastructure. And to ensure fiscal sustainability, you need to look at both the expenditure and the revenue side. And in the revenue side, to not only look at the tax, but what is the incentive mechanism the tax policy is generating in terms of the business environment. And that's why the tax rate has to be such that it actually doesn't hurt these investors to even want to do a PPP transaction. And so that then relates to public service delivery and how you deliver the service in terms of credibility of the government to deliver these outcomes that they are taking on the private sector, and they're saying that the private sector would come in if they see these outcomes. They have to deliver those outcomes. For that, you need revenues. So I think it is still chapter 2 of the entire discussion. It's just that we can't talk about everything at the same time, but we can't ignore it. Thanks.
Thank you, Shan. I think between Shan and Anton, you provided two good answers to both questions. We have run out of time, but if you have a very quick thought, Blanca, that you wanted to share.
It was actually along the lines of what Shan said, that I think for the private sector, showing efforts to mobilize revenues means there is a social contract between the government and society, and also raising fiscal revenues is a much better alternative to finance public expenditures. than the other alternatives. Think about it. Printing money raises inflation, which is bad for the private sector. If you accumulate deficits, you're going to increase the debt, which you then need to finance, and that's going to increase your risk premium. And for countries that are the poorest that are receiving grants, that is also a non-sustainable source of financing. So your best alternative continue to be taxes, but you cannot do it at any price. You have to do it bearing in mind the equity and the efficiency aspects, creating minimum distortions for the private sector, and definitely making sure that people and companies pay according to ability to pay, which is the principle of equity.
Great. Well, thank you. Let me thank once again all our panelists. It's been a great pleasure having you. And my final thought would be, I think we've been convinced that DRM is very important. It's even important for bringing the private sector. It's important for increasing financing of social expenditures. Problem is, it's much easier said than done, right? The devil is in implementation, and it's a long-term process, and it requires government and political civil society ownership, which is again something on which we have not done very well over the years. So I guess those who are here are interested in the topic, and we count on all of your contributions for moving on this agenda. Thank you once again.